Welcome to Bloomberg Law on Demand. I'm Lee Pacchia. Frank Aquila, a partner at the law firm Sullivan Cromwell, joins me now to discuss recent merger and acquisition developments. Frank, thanks so much for coming in. Good to see you.
Good to see you.
So, the state of play in M&A. This is kind of a touchy-feely question, but sometimes there's room for touchy-feely discourse when talking finance and news. How do things feel in the M&A environment right now? What's the adjective?
The adjective is, I'm going to use an adjective that a lot of people aren't using right now, and that's caution. And the reason I say that is we're seeing a lot of activity, and that has been as expected. And there's a pretty good deal flow, and certainly the first quarter, which we're almost at the end of, has been an excellent quarter for M&A. But still, deals are moving a little bit more slowly, managements are a bit more cautious, and boards are being a bit more cautious. So I think that's the adjective I would use. Having said that, though, we are seemingly at the beginning of a cyclical upturn in the M&A market. It's something that I think most people would have expected over the course of the last year or so, but certainly most people who follow M&A, both in the U.S. and globally, have been predicting for the last few months.
Wanted to pick up on a Bloomberg News article that said premiums in deals is at the highest level now since post-Lehman, since 2007. What to make of that metric?
You know, I've discussed this, I think, with you before, don't put a lot of stock in what the premium is, because the premium really is what's the difference between the merger market value for the company and what the public equity markets are trading at. And so if you are trading at a whopping multiple in the public markets, presumably the premium is going to be lower. And if you're trading at a lower multiple, the premium is going to be much, much higher. So while I think it's an important metric overall to say that it's a good, strong M&A market, I think if you look beyond that, you will see deals with 5% premiums to market and 70% premiums to markets. And that's very individual to that particular transaction. Overall, it's positive.
In terms of quantifying this cycle that we're starting to see unfold, has there been a concentration in the types of deals that are getting done, or sectors or industries? Two different questions.
Yeah, they're different questions, different answers. First of all, I think you're seeing mostly cash deals. That's not to say that there aren't some stock deals there. Mostly cash deals. You're seeing mostly strategic deals. So, you know, a widget company buying a widget company. There is a return of the private equity buyer. We're certainly seeing going private transactions, but they're probably 10, 12, 15% of the M&A market. Back in 2005, 2007, they were probably a third of the M&A market, and they were doing some of the biggest transactions. They're still doing some big transactions, but not at the levels that they were back then. I think the other thing we're seeing is that, to a large extent, people are focusing on their core. This is not 1960s, go out and create a conglomerate. This is work on your core. Sometimes that means extending geographically. It might mean extending your product range. It might be, you know, adding a brand or a product that fits in with your overall product line. So that's the type of deals that we're seeing. And, you know, I was with some folks the other evening and talking about deals now, and what this particular banker was saying was that, you know, by and large, most of the deals that, you know, he's been working on and that he's just been, even ones that he wasn't working on, made strategic sense. They were logical from an industrial standpoint, and he thought that bode well. I think part of that is, as I said before, people are being a bit more cautious. And when you're cautious, you're less likely to do that really aggressive, risky deal that, if it works out, is going to be spectacular, but if it doesn't, it's going to be a dismal failure. So I think what you're seeing is a lot of really good, solid strategic transactions flowing at this point.
Back in October, we were able to sit down with your colleague, the great Raj Cohen from Sullivan Cromwell. He was of the opinion that in light of Dodd-Frank, there was a potential, at least, for a wave of consolidation to hit banking and finance. There have been some deals, as we were talking about earlier, but largely that great wave hasn't quite materialized. Why do you think that has come to be the reality?
Well, I don't know specifically what Raj had said then, but I suspect that what he's anticipating is that when all is said on regulatory reform and everyone knows what the financial institution landscape is going to be like going forward, then at that point you will see another round of financial institution consolidation, which we've seen for a long time now in this country. And so I agree that we will see that. But the predicate in Raj's statement was sort of after the regulatory reform is in place. And while Dodd-Frank is
and that's
the
taking
law,
a while.
Exactly. It's the regulations. How is it going to be implemented? Is Congress going to tinker with it as they stress test the regulatory process and understand what the regulations potentially could do? So, will there be another wave of financial institution consolidation? For sure. Is that something you're going to see a huge amount of in the short term? I suspect not. I think institutions will wait until they really know what the future is going to look like, what the implications of Dodd-Frank and Basel III are going to do, and then you'll see that next round of consolidation.
As we move forward in this cycle, I thought it was particularly interesting that you used the word cautious to describe what's happening. I saw in another article a banker used the word unleashed. It has a connotation almost of something to be afraid of. As we go forward, what potentially out there could slow the cycle down? What potentially could change the picture, so to speak?
Well, I think two things. One is the great unknown. If something happens that you and I don't expect, and it's really big and bad, or there's the prospect of it having big and bad consequences, then of course people will pull back.
It makes sense. The market's absorbed so much over the last 3 months between the Arab revolutions, what's happened, the disaster, of course, in Japan. Oil is now over $100 a barrel.
Right.
That's a lot.
I think so if one or more of those situations becomes worse than we currently anticipate, that could be a destabilizing force. The other thing that I think everyone needs to be thinking about is QE2, quantitative easing, supposed to end in June.
Right.
Maybe it does, maybe it doesn't, maybe we have QE3.
If you had to place a bet.
But, here's what I want to say is, whether it's QE2 that ends or we go to QE3 or 4 or 5, whenever that quantitative easing ends, what does the economy look like post-quantitative easing? And given the fact that the U.S. has never had this level of quantitative easing before, we really don't have any precedents. We can't say, let's go look at what happened in 1972 when they stopped quantitative easing, because it didn't happen before. So I think that for me, looking out and saying, what is a factor that could specifically hit the financial markets it's the end of quantitative easing, in whatever form that takes, whenever it takes, whatever. Having said that, I suspect the Fed knows that, is thinking about it, and is trying to determine how they're going to take the patient off the morphine.
Right. No, it's got to be a heck of a problem. As you said, there's no template for coming off of this level. If you had to speculate, do you think we'll see a third round of quantitative easing?
Yeah, that's not my forte. I suspect that no one's wants to talk about QE3 or anything like that, I suspect. However, I think what they will do is slowly ease off of it. How that's done, how it's labeled as a policy matter and otherwise, remains to be seen, whether it's done over the course of a few months, whether it's done over the course of a couple of years. Who knows? But I think one of the things we know is that Chairman Bernanke, and I'm talking about him in his academic role, has been a scholar of both the Great Depression and someone who has thought long and hard about the Japanese lost decade. And as a consequence of that, he, I'm sure, is very concerned that the U.S. economy does not really, certainly he doesn't want to see another recession or negative growth. I think he also understands that, particularly given the point that we're at, that stagnation in the economy is probably not acceptable, that we really do need real economic growth to create jobs, to get asset values up, because if you don't, there's going to be long-term sustained problems, and whether or not there's a lot of M&A activity probably then is the least of our concerns.
Strange days indeed. Frank, we're going to have to leave it there for now, but I want to thank you so much for coming in today.
Good to see you.
Appreciate it. Good to see you. It's Frank Aquila. He's an attorney at the law firm Sullivan Cromwell, based here in New York. If you'd like to learn more about the issues we just discussed, please check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.